Hey everybody, it's Daniel here from InfoRest. Hope you're all doing well. So let's talk about the CPI report, US inflation report that just came out recently. We had the year-over-year number, the headline number come in higher than expected, 3.7%, and you had the core number just basically come in line. Now, when you look at this report, you may argue that, hey, the headline number was expected to go higher because we saw that oil prices were rallying, making new highs, yet the core number, right, wouldn't see a much of an uptick because it doesn't have the energy component in that number. So, the two ways to look at this CPI report is, half glass full, half glass empty, right? The half glass full is that the argument there is that we would see that, this number is not so bad. It's just coming from the oil prices, and since oil prices are moving up higher, that doesn't generally mean that everything else is skyrocketing, and we expected that this number was going to go higher. So, shrug the number off, not a big deal, buy the dip, right? Which we did see that in equities and bonds. Bonds did rally on the number. Yes, it did have an initial knee-jerk down. Bonds, same thing with stocks. We did see the initial knee-jerk down on the reaction of the data, but then right away, bonds were the first one to reverse the move, rally forward, and continue to make new highs on the day. And then later, equities were a little bit mixed in the beginning and did the same thing. And then the next day on, we saw equities rally forward. But here's the thing, right? The choppiness in the equity markets, basically shows the uncertainty on this number. Again, the half glass full, half glass empty. The half glass empty argument is that, hey, when you look at the CPI report, that's not a good thing because headline number is the number that the media reports. It's the number that the consumer looks at, right? Not the report itself, but what I mean by that is the gasoline numbers, because gasoline energy is tied in that headline number, that 3.7%. And when you see consumers go out and they're purchasing gas, they see that they're paying more for gas. That's going to seep into the consumer's expectation that inflation is not getting better. Things are getting more costly. So that's not a good thing, because we heard the central bank a year ago talk about that the headline number is still important, even though the consumers don't know much about the core number. It's still important because that sets the expectations of the consumer. So if that number is going higher, they want consumers to feel that the number is actually getting better and prices are getting better. And it's hard to do that when you have headline number going up higher, when you have the media reporting that, hey, we're seeing higher prices, creating this fear in the economy and so on, and creating also, most importantly, this acceptance, right? This acceptance that this is inflation, this is price, this is how the economy is, so pay for it anyways, right? And if you continue with that, then you're not going to get, it's going to be very difficult to get the inflation to come down because the consumers are just simply accepting it. Now, that was last year, right? That was the problem of last year. Now, this year, we're starting to see the demand pain, the crunch in the demand, right? Now, how is that going to play in with, if we start to see this uptick like we did in the last report, but if crude oil continues to go up, and it has been, if you look at crude oil, it's now sitting around $91. If that continues to go higher, then you're going to see that in the next CPI report and the next one, and that's going to cause the consumers to feel the pinch further, be really upset with this scenario there, and with the demand crunch that we're seeing, it's going to create a lot of pain for businesses outside. Now, last year, we had the acceptance of inflation, right? Where consumers were just accepting whatever high prices are there. Now you're starting to see that that acceptance is there, but the ability to manage the cost and the ability to manage the high prices is getting more and more difficult. So as they increase, the central banks around the world, as they increase higher rates, you're seeing that in higher rent, you're seeing that higher mortgages, right? Now on top of that, you have higher energy, gasoline prices, and food prices haven't come down quite significantly yet. This is going to put a more strain on the consumer, which means the consumer spending is going to start to slow down, which means that's going to trickle into the businesses, which means that the businesses have to start thinking about maybe lowering their prices or something in order to offset this lower demand. Now, again, it comes back to, if they can't do that, then how will they cut their costs? The businesses will cut their costs in one way, very easy way, which we have seen in previous recessions. And what is that? That is layoffs, job losses. So that's the next step forward. If the businesses are forecasting or expecting that we're going to see this demand crunch, this issue in demand, and prices are going up, that means higher costs for businesses. And as consumers were accepting higher prices last year, this year and next year is going to be difficult to just simply accept, because you're going to get a lot of consumers really dialed down into cost saving and really start to pick, okay, what do we need to eliminate from our spending? We need to eliminate maybe going out more, eliminate traveling. A very good example is the airlines industry. The airlines industries are, a lot of the airline companies out there are reporting that they forecast higher cost in the next quarter, and they forecast lower growth in their company, lower profit expectations in their companies, because this higher cost will eat up into their business as consumers are starting to really dial down on the traveling and really step back because they're feeling the pinch, right? The money is all that stimulus money that we saw during COVID time, during 2021, and a little bit in 2022, you could argue. We're starting to see that come to an end very soon. And as that comes to an end, as credit card levels also reach to high all-time highs, people are living off credit day by day. They're starting to also get their limits on their credit cards start to reach, unable to pay their their credit on time, maybe missing a couple of payments. As that continues, you're seeing that demand crunch, and you're seeing that play out into the businesses. So yes, one side of it, the reason why inflation is up because of the oil prices. Oil tends to be very volatile, and last month, in this report, oil went up by 10%. We could see that again. And if oil prices continue to go up, you're going to see that headline number continue to move up higher in terms of inflation. And as that happens, you're going to get the cost cutting from the consumers. And now it's all going to be dependent on, are we going to see this recession? What's the central bank going to do? Right? With all the data that they're seeing, with all the weakness in demand, or starting to see the weakness in demand, is the central bank the U.S. central bank going to pause here, or are they going to go out and say, okay, we're going to have to continue to hike rates and create more pain for the consumers because this headline number needs to come down, right? So if that's the case, then guess what? 2024 doesn't look like it's going to look good. It might be ugly, because if already you've got airlines industry expecting that, next quarter is not going to be so good with the higher costs of oil and the slowdown in demand, then what makes you think that going forward into next year, if rates go up or they just stay where they are, stay higher for longer, how is that going to make any situation in the economy better? Unless, again, half glass full, you think you're going to get a soft landing, you think this is just a temporary blip, it's going to come down, it's just energy related, other components will come down, you'll start to ease, and somehow we will escape the recession and not have a hard landing. So let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified on the next video, and I'll see you guys around. Cheers, bye.